This chapter tells a very simple story. What is the difference between absorption costing and variable costing, and why do we care? You're already familiar with absorption costing. That's what you learned in financial accounting. It's required by GAAP for external reporting because GAAP believes that absorption costing follows the matching principle best. In absorption costing, we take sales revenue, subtract cost of goods sold, and that gives us gross profit. Cost of goods sold includes the direct materials, direct labor, and variable manufacturing overhead that are associated with the units that were sold, plus those units' share of allocated fixed manufacturing overhead. But we don't get to keep all of the gross profit. We need to subtract out all of the selling and administrative costs to get operating income. Those selling and administrative costs include a variable component, which is usually sales commissions, and a fixed component, which includes all of the salaries and the fixed costs associated with operating the firm, but not associated with producing the unit. By contrast, variable costing is not acceptable for GAAP, but it is important for internal decision making. In variable costing, we take sales revenue and subtract out all of the variable costs to get contribution margin, as we did in the previous chapter. Those variable costs include direct material, direct labor, variable manufacturing overhead, and variable selling and administrative costs associated with the units that were sold. But we don't get to keep all of the contribution margin. Instead, we still need to subtract out all of the fixed costs in order to get operating income. Those fixed costs include all of the fixed manufacturing overhead and all of the fixed selling and administrative costs that were incurred during the period. We've seen these diagrams before. Let's look first at traditional absorption costing. The height of the bar indicates total sales revenue, but we don't get to keep all of that sales revenue. A portion of it goes to cover all of our manufacturing costs, materials, labor, and fixed and variable manufacturing overhead. That leaves us with gross profit. Part of the gross profit goes to cover our fixed and variable selling and administrative costs. That leaves us with operating income. On a variable costing or contribution margin income statement, the height of the bar still indicates total sales revenue. We subtract out all of the variable costs. In other words, we include variable selling and administrative costs in these variable costs, and we leave out fixed manufacturing overhead because it's not variable. This gives us contribution margin, but we don't get to keep all of that. We subtract out our fixed costs, fixed manufacturing overhead, and fixed selling and administrative. And that gives us our operating income. The question is, will the firm's profit be the same under both of these methods? Let's take a look at the difference between variable costing and absorption costing in another way. Remember that GAAP requires firms to use absorption costing for external financial reporting. Absorption costing gets its name because GAAP requires that each unit produced has to absorb all of the costs associated with its production: direct materials, direct labor, and fixed and variable manufacturing overhead. These are treated as product costs. So what happens to the product costs depends on what happens to the units that are attached to it. Units that are sold carry their share of the product costs to the income statement so that they can be matched to the sales revenue that those units generated. By contrast, the cost of the units that aren't sold is capitalized as ending inventory on the balance sheet. Selling and administrative costs are never considered product costs. Instead, they're expensed each period on the income statement. GAAP requires that both the cost of goods sold and the period costs are matched against revenues on the income statement. That's the matching principle. Now let's take a look at variable costing. Remember, variable costing is not acceptable for external financial reporting. However, it's very useful for internal decision-making. In this scenario, fixed manufacturing overhead is not treated as a product cost. Instead, it's treated as a period costs, the way that we treat fixed selling and administrative costs. That means that the only product costs are direct materials, direct labor, and variable manufacturing overhead. What happens to these three product costs depends on what happens to the units that are attached to it. For the units that get sold, those variable costs will be considered on the income statement. For the units that aren't sold, their variable costs will be capitalized as ending inventory on the balance sheet. The firm's fixed manufacturing overhead and fixed selling and administrative are expensed in the period when they are incurred. That means that they're going to be treated as period costs on the income statement. That leaves us with variable selling and administrative costs. These are not fixed costs, but they're also not product costs. They go directly to the income statement as variable costs, even though they're not counted as part of product costs. Here's a question. What would you say the key difference is between absorption costing and variable costing? Think about it for a moment. That's right. In absorption costing, fixed manufacturing overhead is treated as a product cost. What method should be used for external reporting to investors and creditors? GAAP requires absorption costing for external financial reporting. But the reason the GAAP has this requirement is that it believes that there's better matching between the costs and revenues. So both of these answers are correct. Is profit always the same under both of these methods? The answer is that it depends on the number of units that are made and the number of units that are sold. The rest of Chapter 21 deals with why this is true.